talk about something visionary here that I prepared for you. And this is my slides that I modify every time I'm going to teach. So you have a version of these slides, but it's a little bit far from what we are using. So we are going to load this for you. You know, I always have the difficulty of kind of introducing you the needs for an idea. You have to go from the big to the small. Can you tell me what this is? Germ, a galaxy, naked girl, if you have a single-minded mind, or guy. You see, everyone has different theory. It's like a Rorschach test, correct? Does this tell you a little bit more? Does this tell you a little bit more? So what did we do? I showed you a little detail here, and you had no idea what it was. Then I gave you a bigger detail. You got an idea what it was, but you didn't understand the details. And then I tagged it, and then you understood much better the details. And this is kind of what XBRL really does, is you have this big ocean of data, and then you put a tag around each datum, and you explain what data is. Now, this is actually a slide that was presented maybe 15 years ago by the AICPA. I prepared it for them. And I was talking about the evolution towards a more automated form of audit. And it has to go automated form of audit, goes with automated form of accounting. And this is a representation of how an ERP actually works. You market, you sell. Some of the things that you sell become cash. Some of the things that you sell becomes receivables. Some of those receivables got paid in 30 days. Some of those receivables are never paid. Correct? At the same time, when you sell, you have to take inventory out, provision it, and then a little bit later you have to take care of it by customer support, this and that. All of those kind of come together. Now, some things to observe that you need to know progressively. The first thing is that this stuff here has a timing to it. It's not the moment that you market that you sell. It's not the moment that sell that you collect. It's not the moment that you sell that you provision. And certainly it's not the moment when you care. Seems very obvious, but in accounting equations, there is no timing in it, although there are dates on it. And actually, Professor Kogan does something called continuity equations, where he links these things by timing. And by doing this, you can predict much better the levels of transactions, and you can do better predictive modeling. Okay, so remember this. Now, these things that are happening in business are represented in the ERP, in the data level, by measurements. And so when you are using your ERP, your databases, and I don't know, I don't know if you remember, talk about relating tables, relationships of tables. And that's what actually is happening. Some of these are in one table, some of these are in other tables, some of these are other tables, and sometimes you want to link them together. And you do that in a relational database by relating a common field. And if you ever use Access, that's what you do. You choose a table and then you choose a field to bring them together. Now, first there is this correspondence between what's happening and a measurement. What's happening and a measurement. And sometimes several things happening and measurements. And this is what happens in ERPs today. Now, I already mentioned that there is a delay factor, so there is a timing factor here for modeling. Now, the next, now is the more conceptual part of it, is you can create relationships. And I always say that you would do much better for a company, instead of publishing balance sheets and income statement, writing equations that express the dynamics of their processes. So the stockholder can say, well, one company for every marketing dollar that they do, they get a factor of 1. Other one would just get a factor of 0.5, so the marketing is weak. So the parameterization of these equations would be very interesting. So if I can get one of the partners or one of the accountants to agree with me, they always say, we also need a balance sheet and the income statement. I'm not sure about that, but that's their opinion, usually. But this is another way to represent the same story, but instead of publishing numbers or publishing tables, publishing relationships. And you say, well, this sounds intricate. You know, if you are in a sales situation, you are going to market, let's say, advertising to a company. They come with these equations. They say, for every dollar that you spend at here, you get a stimulation of 5, etc., etc. They come with equations. They might not call it equation, but that's what they do. They do those studies and to justify their business. Yes. You just took it much farther than I wanted to take. Okay? I'm not talking about regressions yet. I'm just talking that you can represent the relationships in a business by equations that relate those variables at different levels of aggregation. You can do it by product. You can do it by division. You can do it for the company in its total. You could do it by the industry. Okay? That's what I'm saying. Now, you are not wrong. Very often, the way to develop these equations is running regressions. And that's what we did when we were trying to represent HCA and their supply chain. But for what you need to understand here is this is what's happening, this is the databases, and these are symbolic ways to represent. And you need symbolic ways to be able to control and manage. So the other level, the next level, is what many companies do today. Actually, I don't know where Pei picked up her dashboard, but many companies now has these dashboards. And this is something that you'll need in this MBA very often, is the concept of KPI, Key Performance Indicators. And the key performance indicators are variables that you pick up in the operation of the company for evaluating something. Okay, like for example, hospital bed occupancy is a very good predictor of revenue in hospitals. Airplane seat occupancy is a very good predictor of airline performance. Level of reservation in airline databases related to the cyclicality of the airline is a very good predictor of earnings, predictor of occupancy, and et cetera, et cetera. So I said, well, the reservation, you predict occupancy, which predicts income. What does it say? These things are interlinked. And companies still don't have the real good real-line online systems that they can do real-time auditing and real-time accounting. So what they actually do is the poor cousin of this. They create KPIs and manage it. Now, the other concept that now became quite popular, they talk a lot about it, is KRIs, Key Risk Indicators. And now they pick up KPIs relate to different factors and come up with risk indicators. So a lot of the audit today is a risk-oriented audit. What does that mean? You decide what the risks are, the main elements of your company, and then you emphasize auditing the things that are more risky. It's a longer story than that, but that's the beginning we talk. So you need to learn this idea of a KPI, a KRI, and that's kind of the other level of control. You are still not controlling directly at the very high level everything, but you are picking up key performance indicators. KRI would be level of exposure on your debt. Okay? Like I am 70% indebted in my real estate holdings. Or I am 70% indebted in my real estate holdings. Industry is only 60, so I'm 1.2 of the industry. Okay, and you know, each business, each segment, each product have different type of risk indicators. Like, for example, your level of customer complaints is a risk indicator. So if you get, for every 1,000 sales, 3 complaints might be okay, but getting 7 might not be okay. So you develop these ratios, which are risk indicators. And there are bankruptcy risk, there is indebtedness risk, there is fault risk, etc. And I guarantee you that companies like GM and Toyota keep very tight records of customer complaints. And you know what they do also? They read blogs, they read emails, and try to pick up when people are communicating between themselves on problems with a GM car, or with a Toyota. Yeah, David. I think you're probably right, actually. I think, and what they are learning, meaning leading companies do, but this takes very good technology to be able to pick up, let's say, customer comments in your blogs. Takes a lot of technology. So I guess some companies do, some companies don't. Meaning it's very clear Google does a lot of monitoring of customer attention. Okay. So what is it? Can someone else explain to him what a key performance indicator is? Yeah. See how many people are doing Skype while class is going on. And look at the IP numbers of the addressee email and calculate how many are using Skype or how many are looking at the intermediate accounting exercises. Okay? I gave you example key performance indicators. Occupancy of seats in airplanes, hospital bed occupancy, ratio of sales to inventory being held, et cetera, et cetera, et cetera. Okay? And finally, the kind of higher level of monitoring is when you do this continuous monitoring and reporting. When we presented this in the AICPA, there were practically no companies doing real-time monitoring. Now there are many companies that in certain processes do real-time monitoring. Now, we'll talk more about this, but in order to do, remember I already said this to you, in order to control any process, this is the process, you need to have a model, and you need to have a measurement of what really happening. We call it an actual and the model. Now, a control process is a comparison here and examination of this discrepancy. All control processes are there. If you are monitoring your child in the backyard of your house, you told him, your model was you never go to the front of the house because there are cars there. Okay, that's the model. You are looking and he's running that way. So you immediately detect a discrepancy. Okay, this happens in mental models. You know, your boyfriend should not be looking at other girls. Correct? That's your model. Okay, but if she's ugly, maybe it's okay. Okay? But that's a mental model, but still a control model. It's always where did he look and what he should be doing. Now, the other thing is we use this in our studies, is really very seldom reality matches the model. So you have to say what is the discrepancy. If your kid just runs to the line and doesn't go anywhere, you say, okay, I'll let him do that. However, if he crosses it rapidly, you jump. So it's always this idea of what's an allowable variation. And if the variation is too big, you create an alert or an alarm. This is the model of control, and it applies in everywhere that you're going to do it. So stay with that thought, because we are going to go further with the symbolization here. Okay, how about some clicker questions here? Okay, so the answer here was 94% D. So I'm going to explain to you what the question was. Why would you want to create electronic reports? To increase interoperability. What does that mean? To allow two systems to talk to each other. Second thing, to allow for expanded data granularity. Granularity means more detail. How detailed is a balance sheet figure? Very non-detailed, correct? The other way, you have more intuition with drilling down the word better. You usually drill down to get more granularity. And the words might not have used good. The word expanding data granularity gives kind of a double negative feeling, but making data more granular. The third one, to allow storage and distribution. It's much easier to distribute electronic than to print and send. So you all right is all of the above. But why did I give you the clicker question? To explain A, B, and C. Okay, stay put, because we are going to use these concepts in a second. These are kind of things I was explaining here, different processes dealing with that. Now, what happens is today that you transfer data to the internet. So what's actually happening is data traveling from process to process. And doesn't have to be internet. Could be through wires or to people carrying the data around. And we talked about this before. There are many structural relations in value chain. Typically, a transaction should go from here to here, then to here to here. But sometimes the structure is not respected. And what's happening is companies are outsourcing things that they don't think that they make extra money. You don't outsource critical processes. Why? Because you don't want your competition to do the same thing. So you don't teach someone else to do what you think is your filet mignon. And next thing is what I've been talking for the last classes, is with information technology, our concepts of measurement have become obsolete. The old trade-offs of materiality and FIFO, LIFO, etc., don't make sense anymore. But we still have the laws in the books, so we have to obey it. Now, so this is the one piece of the story. We're going to get to more of the piece. And this is things I was talking with nicer words. There must be sufficient disclosure to ascertain integrated relationship. What does it mean? You have to be able to tell your users enough information. Second, this is my own thing. Consolidation is a terrible thing. Why did you consolidate in financial statements in the old days? There was no photocopies at that time. You had to manually transcribe, or you'd have to show. Okay, so consolidation, which is the big final thing large consolidated companies do, they add accounts together. What does it mean, adding 60% industrial companies to 40% financial companies like GE does? You're adding a bank values to a manufacturing values. What is the result? Mush, means nothing. Banks have no inventory. Industrial companies have very large inventories. Okay, and goes on and on and on. Consolidation is a very bad measure. Now, why do companies did that? Because decades ago, companies didn't have banks. Banks were separate. And people didn't have the ability to copy a lot of reports. And you remember my argument here, I keep repeating. A bad measure is a bad measure, but it's better to have some measure than no measure, unless the measure is totally misleading. So consolidation was good when you couldn't do something else. And this is the example we did yesterday. The measurements of the soft elements must be included. Human capital, intellectual property, social, ecological impact. And so here it is, what's happening today. Things are traveling the internet. They are using web open architecture. So what you can do, they are interoperable, is create a whole set of accounting services that instead of being done within the company, they are done outside the company. And this is what I was saying, that more and more of the process. And I also told you, many of you are going to make your livelihood out of these incremental services. And I just gave you some ideas here. Things that do accounting for you. I call it bot, like robots, but it's really software. And what does that mean? Give you an example. Tax tables. The U.S. has 50 states and large number of municipalities. They actually have different tax rules. So if you are selling from New York City to Tuscaloosa, Alabama, you're going to have to look up in a huge table. And companies, all these companies kept their own tables. So they had to hire special companies to monitor tax rule changes in Alabama, Tuscaloosa. Now, there's a natural service that they can, you don't need to hire anyone. You just send in 2 zip codes, yours and theirs, and you get what is the tax to apply. Then you pay half a cent for it. Now there are a lot of companies that sell, and we are doing a project with web filings. And web filings compete with Donnelly in rendering required reports. Things like 4Ks, 4Qs, XBRL. So what is it? You are a company, you don't want to learn about XBRL, so you give your reports to web filings, and they transform it into XBRL. In the process, they also post it on Edgar, 4Ks, 4Qs, and et cetera, et cetera, et cetera. So this is a web service, layered reporting. You can audit automatically. You can detect fraud. You can do all kinds of analytical services. You can do other kind of audit services. And some of these don't exist. You can make money on it. And you actually can outsource your ERP. Now, what does this require? This requires that the sender and the receiver interoperate, that they speak the same language, and that's XML. And this is kind of open systems architecture, and the idea behind this is let's make things understand each other. And so we don't need to carry them, you don't need to FedEx them. What you need to do is create a language like XML of things understanding each other. And so this is the same conceptualization. And what I did here is I said, this is a very good idea, but there is a lot of research needed to be performed around this. And the other thing is that we have obsolete laws. And you're going to say, you said that the FD rule is obsolete. Do you know what the FD rule is? It's called the full disclosure rule. And it's the SEC rule to avoid you to leak information to your favorite analysts and withhold information from the analyst. Leak information to your buddies and withhold information for other things. So the rule, the FD standing for full disclosure, says you disclose the same thing to every outside source. Sounds like a good idea, correct?
No.
Why not, Michael? So you don't like the FD rule. Okay. It's a pretty good rule to avoid insider trading, to avoid manipulating your auditors, and exactly what you said. There are a lot of unintended consequences in the FD rule. My basically objection with the FD rule is that there are maybe 20 or 30 stakeholders of business that need that information on different forms. And you finish up having to disclose it. You disclose your earnings, but you have to disclose your assets to the people that hold mortgages to you. You have to disclose all kind of inventory information to certain state entities and etc. So FD rule is very anachronistic. It's designed for a paper-oriented world. And actually what they have these days to avoid leakage information, they have these earnings announcement webcasts. And they give a number, anyone can call in, and then the CEO or the CFO tells the story of that quarter. But that's kind of an old rule. And it's not that old. It's only like 15 years after accepted. Okay, I'm going to leave this explanation for a little bit later. Let's go to the next one. This is actually what XML is. Let's suppose that we are talking about cash. And your cash number in your financial statement would be 200. So you can pick up that piece of paper, take it to the next person in the value chain, say, this is my 200 cash. And then you pick up the next account you have and you take it over. Now, better than that, you tag it. What does it mean? This is cash. This is 2014. No, actually, this is 200. This is 2014. This is cash. So it says what account it is. This is budget, or this is a financial reported number. So these tags explain what this number is. And when you send this to the next computer, in the top of it, it says XBRL. When the other computer receives it, he says, oh, this is XML. Oh, this is not only XML, but this is XBRL. So I read it as XBRL. However, if I don't know how to read it as XBRL, I know where to go to get an XBRL interpreter. So this is totally self-contained in explanation. So remember the word I use, interoperability means what? Two computers that never met can talk to each other. And this exists, as I said before, on 300 to 400 dialects of XML in the different industries. And I bet you that in your prior works, you had run into XML derivatives. Meaning the toy industry has that, the electronic parts industry has that, the public relation industry has that. the financial instrument has that. All of them has their own dialects. And these dialects are designed to basically explain their data between two computers. So you create interoperability. No more card punching, no more re-punching data and making mistakes. Is passing the data. Sounds very trivial just not to punch data. Is the most major problem of inter-process delays. So that's the reason for creating this thing. Now it doesn't look this way. This is a way to explain it. Okay, and this is something that really doesn't exist in the dialect, and I think there should be some kind of control label. It's a way to make sure that this wasn't tampered. Sequential numbers, encrypted, sums of sequential transactions, ways to keep tab that someone didn't come here and change a number. And that doesn't exist in the dialect. We propose it. No one seemed to be particularly interested. Okay, now this is, so you know one little piece. These are called them elephant paws. And there's each one is one piece of datum. One thing for you to immediately understand. 200 occupies 1 byte. 200 with 20 labels around it occupies 2,000 bytes. So these things are not efficient at all. Okay, it occupies much more computer space, XML, than pure data. But this is like carrying your explanation with yourself. Doesn't depend to ever go back and etc. And replacing computer processor, human processor for computer processor is always beneficial. So I wouldn't take very seriously this argument that XBRL is very voluminous compared with traditional statements. Yes, it occupies more storage space, but storage space is free or very, very cheap. And what that avoids is to have, then you have to pick up the data, type it in, and et cetera, et cetera. The difference is totally dramatic. David? Cannot answer that question because on each instance is different. Okay, depends how you define your tags, how many tags you have, which ones you fill up, which ones you don't fill up. 20 times? Storage costs nothing. 1 minute of your time costs more than all the advantage of or disadvantage of that storage. Okay. However, there are moments that tagging is not so good. You don't want to put the data in a relational database that is tagged because you have to untag and tag all the time. So you want pure data here. And some people don't understand that. Tagging is good for transmitting. Tagging is a method of intercompany or inter-process transmission of data. And is mainly for intercompany because the intercompany you can tie the processes together and don't need to explain it because they know anything I get from this computer is this, and I know how to treat it. And of course, within an ERP, things are not tagged.
You don't have to worry about that.
Not very much. It's when you go outside. But you know, the advantage of intra-company tagging for transmission data is that you can use tools that are totally ready, and you just bring a tool that can understand XML and et cetera, et cetera. And actually, some of them are doing that. Now, the big vendors, which are SAP and Oracle, are not very fond of transmitting things in XBRL or in XML in general. Why? Because they're opening the door for much more interoperability. And that's not good for them because then people are going to buy cheaper software and use instead of them. So the people that dominate an industry don't like standards that are not their own standards. They want to force everyone to use their standard. You think Microsoft cooperates a lot with the other PC vendors in standards? They really don't like that very much. It's a dominating an industry. If the standard for word processing is Word, you really don't want people to use Word Perfect. It's a different software. And so you don't facilitate. You don't say, okay, when you record this, I can record it in Word, and in WordPerfect. So someone that has a WordPerfect software can use it. For a long time, Apple didn't really want the Word standard, correct? But they have to give up. People were not buying Apples because they wanted to. Huh? The usual story, David, the usual story is the following. Dominant software makers and hardware makers keep their own standard, makes it difficult to transfer somewhere to other standard. Little vendors obviously make themselves compatible with the big vendors so they can import and export from them. Yeah, something like that, yeah. Microsoft was much more difficult in translation. Now they facilitate the life a little bit for all kind of other reasons. But in general, remember this. Large vendors don't like public standards. Now, these things are symbolic, of course. And these are each one data being transmitted in XML. So the vision is data arrives in XML, and the data is about inventories, physical goods, labor purchases, paying for people, and services that you buy from third-party companies. They all come in, and they are placed in an ERP. Okay? But as I said to you before, they usually are stripped of the tags because there is software here that understands them and puts them in nice little tables like Pei was showing you. This is all name of a person. This is all an address of the person. It's not address here, a tag saying this is an address, a tag saying this is 1932, night saying this is a vendor, etc., etc. So it cleans it up and puts it in the ERP. Now, I talked about XBRL. And XBRL has at least two dialects, many others, but let's talk about these two. The one everyone talks about, we call XBRL FR. FR standing for financial reporting. And what that is, simplifying a little bit, but good enough to understand. You went to press, you printed your balance sheet in your financial statement. Okay. So you picked up every number of your balance sheet and created a tagged version of that. So it's 200, and then it goes something like cash, and then finishing cash, etc. And so each one of them gets coded in there, and there is some modules that say this is 1990, this is GE, etc., etc. So this little thing here becomes a big explanation, and this is only the table. Now, the footnotes now have to be tagged too, so there is there is pension footnote. And in the pension footnote, there is the description of the footnote, and then there is finish pension footnote. And I'm not trying to stay with the dialogue, I'm just trying to explain you how this works. So actually what we have today in XBRL is exactly what you have in the annual report. And so that's why I say XBRL FR is electronic paper in one sense. They are copying exactly what's in the financial paper. It doesn't take advantage, meaning it could very easy to drill down from this 200 and say, well, this is my division A, this is 120 division A, 15 division B, and other residual 30 in division C. And then you could kind of drill it up. But that's not happening. XBRL is exactly the level of the financial statement. Now, this guy, Eric Cohen from PwC, invited to come and talk to your class. He's demurring. He might come, he might not come. He might also talk by Skype. So let's see if Eric comes or not. But Eric developed this thing called XBRL GL, Global Ledger. And XBRL GL actually, instead of capturing the information at the balance sheet level, captures the information at the subledger level, like a transaction information. It's much less complex, but it's very detailed. And Eric has been talking about this for 10 years. We worked on the XBRL original task force together. And at that time, when they just started, I made a plea, emotional plea to the committee to go at the transaction level. Because I said, you do at the financial level, statement level, you are not capturing any advantage of electronic transfer. All what you are really doing is creating paper in electronics. You are facilitating transferring information, facilitating importing into a spreadsheet, but really you're not improving financial reporting. But they stuck to that and they did what they wanted to do. Eric actually said that wasn't such a bad idea. Let's create a version of XBRL, which is GL. And for about 10 years I've been talking about this and no one paid any attention. Just recently they started to pay some attention, and seems that the Brazilian government is requiring certain municipalities to disclose in GL. And seems that there is several tax authorities that are requiring GL now in different countries. And actually this is what's going to happen. What's going to happen is, obviously accounting information will be electronic. And to be electronic and to be practical has to be tagged. And this tagging then can be used by many computers to transfer information. Now, it's likely there's going to be XML, XBRL, for sure. It's likely. But it could be that the United Nations come up with some other electronic tagging schemata and people adopt it. But it will be difficult because SEC already decreed on XBRL, and unfortunately at XBRL, FI. Yes, David. It's like IFRS and GAAP.
Yeah, it's like America has to own.
Yeah. I proposed this fantastic XBRL project to Morgan Stanley. Okay? And it was 15 years ago, the beginning of XBRL. And they got very interested, and so I went to talk with Trevor Harris. And Trevor was actually my colleague when I was teaching at Columbia, a little bit younger. And he was the big honcho at Morgan Stanley at that time, and he refused it. He canceled the project, said it's a bad idea, because IFRS is going to be here, and all financial statements are going to be following the same rules. 15 years passed, and every country has their own IFRS dialect. They are not compatible, and it's not totally clear the U.S. is going in that direction. The more likely that's going to happen in the U.S. is the U.S. is going to go with, you can file either way, but be consistent, and some discouraging of using IFRS. Ask Alex what he thinks, Sonella, what he thinks about that. But expecting that the municipality of Naples, Italy, with their complex, intricate rules, adopts standard developed by the IFRS is zero. They are going to force their own ways of accounting for their taxes. And you've seen this, even the US doesn't want to go IFRS. And by the way, the IFRS standard is not as good as GAAP. And you know what I feel about GAAP. So meaning, one is junk, the other is junk squared. Because, they have this idea of principle-based accounting as opposed to rule-based accounting. And this became very, very popular during the crisis that generated Sarbanes-Oxley. And say, well, those fixed rules created all this mess. But tell me one thing. Is there any computer that can compute principles? Computers do numbers. And rigid rules. So you can talk until you turn pink about principle-based accounting. I might even give them a little bit credibility, say, in theory it's a good idea, but in practice it's not going to work. How does accounting happen today? Accounting happens the following way. The FASB comes up with some stupid rule about leases. Very bad rule that they just came up with. Then Microsoft, GE, accountants sit down and figure out what did this guy say. And they don't understand the thing, because part of those rules were compromises. I have been in these committees. I understand how they work. And the part of were compromise, etc. So they write the rules in computer code to be interpreted, and then they write a letter to the FASB saying, how do we do this? And then there is interpretation after interpretation that comes out, trying to make fuzzy logic into real logic. But I'm not making this up. This is what happens. Okay, and after a while they get tired of asking the question because they're very little detail. They just invent the rules themselves. Because you can't manually code 10,000 leases that you have in your books. And every time interpret it. Did we get to 75% of the life? What is 75% life when this lease was renewed 2 times? It's just not doable. The decision tree becomes very big. So this whole thing about principle-based accounting makes no sense in the age of computers and definite rules. And so, I said this to the FASB. We wrote articles. JP did his dissertation on this, formalization of accounting standards. And I say the same thing about auditing. Auditing is going to be all automated. The rules have to be very, very clear. They should be written in Unicode, which is a way to formally describe something, and then you can use any computer language to create it. And so don't even expect in the long range to homogenize the IFRS with GAAP. I don't think it's going to happen. Okay, now, you collect these things, they arrive into your company, you put them in ERPs. Ideally, you would have them represent a GL, but that's not going to happen. And now is the most interesting story. By the way, I have a slide that's one slide for an hour-and-a-half lecture. It just moves things out. And students found it very, very confusing, so I decided to break it down in a few slides. Okay, so that's where we are. And then one thing for you to report. There are 10,000 reports that come programmed in the ERP, maybe more than that. And then you can write your own report doing what Pei was talking. You link 2 tables. What an ERP is hundreds of tables, thousands of tables here, and applications linking them and extracting the data. In theory, very simple. In practice, they're intricate. And then the other part that I told you last time is that this little piece here is the financial statement. So you have thousands of reports, big data set. Financial statement is only a little piece of it. The rest of the ERP is human resources, inventory, supply chain, all the things that the company needs to manage to be in business. We, as financial statement experts, are in the tail end of the story. The other thing that's happening is that internal audits are looking at everything. They are getting much wider in approaches because they have more access to the data, although they don't have enough. And what companies are not that worried for their survival on the financial statement. Some auditors do that anyway. They are interested on the other things being right. And the more this environment is opaque, meaning it's not only opaque by definition, it's opaque because there's many computer layers and it's difficult to get in there. And the more opaque this thing is, more tools you need around it to interpret the data. Now, remember what I said. You have model, and you have an actual. The model is what I call standards here, and you have an actual that you reported, and if they come out different, there is an alarm. It's always that way. Remember the kid in the backyard. And you can apply that to everywhere you are doing, but these days we don't do that. Now, there we start talking about the fifth level that we talked before. First thing is what I call continuous reporting. What is continuous reporting? You don't need to do FIFO, LIFO, this and that for doing that. You can collect the values of the transactions and accumulate them while they are happening. So you could know what are my sales to this minute. And by the way, some ERPs do that for you. In certain industries where things are time sensitive, you have versions of the ERP that pick up information very close to real time. And in accounting, you do two types of things: balances and flows. And I call it the bucket theory of accounting. This is any account you may think of. That's a balance account. And it has two levels: beginning level, level 0, and level 1. And there are things that flow in, there are things that flow out. And if more flows in than flows out, the level goes up, and vice versa. Very simple. Flows are income statement. Levels are balance sheet. For you to establish the level of an account correctly, you have to measure at the moment that you are closing. On the other hand, to measure flows, you need to accumulate. Meaning, what was my income for the last 3 months? You have to pick up every day's income and add it together. Correct? Yes, no, maybe. So there are these two things that are very different. One modifies the balances, the other one is the balances. And so, while things are happening, you're accumulating values of transactions. When you close a period, you have the balances. And the same thing, you have to think this is very intuitive. When you're auditing, you audit balances. But to audit balances, you need to go and count inventory. You close in December 31st, you go there and figure out how many items are sitting over there. Go into your cash till, see how much cash you have sitting there. Pick up your checking account and look at what balance you have there. You are measuring a point in time. But income, you're not measuring a point in time. You're measuring everything. It's like the integral of a curve. This was your income over the year. For this year is the area of this curve. Each day is a value. So you can count balances, if you are willing to, reasonably well. But income, you really need to rely on control systems. You need to be able to understand that the very day measurement of that income is correct, is well done. So that's why in traditional auditing, you have basically two stages of the work. One stage is the year-end work. And this is the one yesterday Anthony Sanella was talking to me and was saying, in the 4 or 5 months after the big close ends, we don't sleep, we work until midnight. Okay? And he's actually in tax, wasn't him? What was his name? I think William. Yeah, William was talking to me. And they say this is what anomaly of the accounting profession. You work very hard after the year end. And then you do this thing called interim work. You're basically evaluating controls. Not very much more than that. And what you try to do is do the most you can here to do less here. And of course, you could create a balance sheet or income statement of a company any moment of life, correct? A company called Cisco has a thing they call virtual close. And the virtual close, and Motorola now copied it, several people copied. What is a virtual close? They every day create a balance sheet and income statement for that day. And Motorola copied it and accepted. Actually, these days, a lot of people need this kind of closing balances for the day, and they use it for one reason or the other. Now, the one thing that you need to start understanding is that a balance sheet, the way we count today, and the income statement are not very good continuous measurements. That's not what you want to provide. Let me ask you the following question. Do you prefer to have inventory on a FIFO basis or LIFO basis, or you prefer your inventory measured at their values today? Why do you measure inventory? To know the value of the assets on your company. Although physical assets are less valuable, important today than were before. Yes?
No one cares about cash balance, about present value.
Yeah. You know, the only thing that really is seriously affecting those valuations is taxes. Okay? Taxes is a real cash outflow. And, you know, if you overstate your cost of inventory, you are saving tax money. So there is some direct tax effect. But a real-time report is going to look very different from what we developed since the Pacioli days. And then associated with this thing, we have kind of different type of continuous auditings. First, verifying if your transactions are properly measured. Second one, you have a lot of estimates in balance sheet. Can you give me an estimate that you use in a balance sheet? Depreciation estimate. Bad debt allowance is probably the most classic that people use. The one I find really interesting is pension liabilities estimates. Okay, this company has these employees, has to pay them when they retire. And they estimate that the return of their investments is 10% a year. Okay? But their historical return on their investment was 3%. And no one even questions this. They can do whatever they want. There is not a questioning of the reliability of those estimates. So very important to verify estimates. Now, one thing about estimates, if you are doing continuous reporting, you estimate much less because you have real-time measurements. And then figuring out if the rules that you are using related to the estimates of all the things are correct, and see what kind of judgments you made and if they are correct. Actually, what we talk most is about transaction assurance these days. Okay, I'm going to leave this in peace because I want to move ahead. You see, I told you this could last for a whole lecture, correct? Okay, let's do a clicker question here. So let me ask you the following question. 70% answered C. First one, are financial statements incorrect? It's a tricky question. It was a trick question I put in here. They don't necessarily incorrect according to GAAP. But they have always been incorrect because they don't measure very well. They are approximation. So it's not this one. Okay? Now, does it mean that you don't need to verify financial statements, assurance, audit? Not really. I told you, although the audits don't measure very good numbers, audits have a great value. Say the company really exists, and it's kind of what they say it is. But the actual numbers are not good, so verifying them doesn't help a lot. Now, the third one is true. The information supply chain, instead of transmitting paper, transmits electronic data. Why did I put this clicker question in? Because I wanted to have this exact discussion. You look a little bit tenuous here. Did you understand those three first explanations? You want me to go over them again? Let me go over again because I see blank faces here. Has made current financial statements incorrect. The fact that you're transmitting and measuring electronically didn't change the rules of measurement, which are the FASB rules. Therefore, it really didn't have any effect on it. Should the financial statements look different? Absolutely. They are not very good measurements. In this age of electronics, make no sense doing FIFO estimates. Second one, made auditing assurance superfluous. Not true. We had this discussion last time, and we came to the following conclusion. There is a value on an audited statement, even if it doesn't verify very good numbers. And what is it? It's because a lot of the fraud, large market fraud in the past, was companies didn't exist. So, if you're reporting $100 billion in sales and you have one building, I don't think the auditors will certify that. Okay, so that's clear. And this one, of course, was obvious. Now, this is actually something I talked last time. And I said, with the progressive electronization of everything, the flow of things is changing. And, this is your supplier, this is your business, that's your client. In the old days when goods were not biddable, they were all physical goods, this what mattered, is the flow. Now, in order to have a business, you need to have very rich information flows between the elements that you have to explain and deal with the contingencies of current business. And actually, if you are transferring information manually by paper, it's inefficient. So what do? You do XML and transfer information from computer to computer in an automatic basis, and transfer information from you to your client on an automatic basis. And what I also said is that this channel of information is getting fatter and fatter. More and more information needs to be transmitted to do business. And you do it with intranets, you do it with internet, or extranet, however you want to call it. And that's the way to transfer it. Okay, this is to make your life a little bit easier on that story. This is a kind of vulgarization of measurement theory. Things happen. You measure what happens either manually or electronically. And we are talking about GPS, RFID measurements, face recognition. But actually, accounting stuff is typically hand measured and collected these days, but it's changing. Now, measurement theory again. You don't measure everything that's happening in the world. You just measure your sales and a couple of other things. Who decides what gets measured? Interesting. It's basically your computer guys. Correct? Your management says, I need this, then they go there and collect it, and they decide what gets collected. It's an information theory. You don't measure everything in the environment. You measure the things that you need to make your business decisions, to make your business process happen. And just for you to kind of think about this as a grand context, the number of things you could measure in the economic environment is close to infinite. You could measure a lot of different things. You could measure if your clients are smiling when they walk in or out of the store. You could measure the name of the girlfriend of your client. You could measure if they have a pimple in their nose. All of these things are potentially measurable. And in the economic environment, you could measure your industry, you could measure your location, you could measure the number of cars going in front of your store. You can't measure everything. So what are you going to measure? the things that you think is more relevant. Okay, or someone thinks, or maybe the ERP you bought think is very relevant. So this is very important from the aspect of measurement theory, which will help you a lot in your accounting. To understand, there is an environment. In this environment, you choose certain variables to measure. Other thing that's happening here is the things you measure are becoming bigger. Why? Because there are new source information coming. Emails didn't exist. Social networks didn't exist. GPS didn't exist. And these things started to existing. If they started to existing and you can make a buck collecting it, you will collect it. It's all about money, correct? Or about pulling the government away. They tell you to do something, so you have to do it. It's about making money. But what's happening here is that your ability to measure economic events increased tremendously. Now, what you're doing in your ERP, you are storing what you collected, and then you're aggregating into telling a story of your company. One more thing is measurement here, Shannon and Weaver. You can always pick up information that is fine, meaning detailed, and aggregate it. But once you aggregate it, you can't go fine again unless you keep the fine on your storage. So if you get a balance sheet, you don't know what the components of the balance sheet are unless a reporting schema exists that collects that information. Okay, you say, this is very theoretical, this is Professor BS kind of thing. It will explain a lot of stuff in accounting if you think this way. One more point about XML is this is the thing we deal, XBRL, we measured, etc. But now you can get all kind of information that will help you. You used to do FIFO and LIFO to collect inventory, correct? Is there a way that you can, at this moment, capture the value of a particular item you keep in inventory? Yep. RFID is a way to tracking it. You're not too far. But real value. I go out and buy a machine. Put it in my property, plant, and equipment. How did I value it traditionally? I base it on my historical cost, and maybe I depreciated it. So I take 10% off every year. Is that a good measurement? No. Now, you have this machine for 2 years. Could you find out the value of this machine? How? Market values out there. Now, is there things like B2B markets, B2C markets, used equipment markets with electronic information out there? Yes or no? A lot. Yeah. More new things than old. But there is a lot of, and there is also analogous information. This is not this, but it's similar. So what do you prefer? I don't like the machine example is not a good example. Buildings are a very good example. Buildings sitting over there. 20 years ago, I paid $10 million for it, so it's not fully depreciated. In my balance sheet, it's reasonably small. Is that an interesting number for anything besides tax calculation? No. Now, can you tell me the value of that building today? You look at the similar buildings in the similar area. What did they sold yesterday for in the last 10 years? You know, you've seen all these websites on real estate telling you recent sales and estimates of value. And I said, there's a pile of them out there. Okay, what's more interesting to the stockholder? Historical value or this value? Yeah. And, you know, it's very interesting. This was kind of something I did research when I was a young professor. believe it or not. I did accounting research. And it was about, because I came from Brazil, a lot of inflation. So Brazil used to do price level adjustments in the balance sheet. And FASB published here FASB 33, which was price level adjustments. So I consulted, when I was Columbia, I consulted for 3 years for the FASB, developing 33, and in the process we developed 36, 37, which were pensions. So we created the first database the FASB ever had to do their analysis. Sandy Burton and myself developed it. Okay. At that time, there were all these theories of value. Historical cost, price level adjusted cost. So I bought that for 10 million. Price level changed by 50%, so now the value is 15 million. Replacement cost new. That's what the SEC with statement 190 told you to say. So you would have to figure out how much it would cost me today to build that building. Replacement cost used. What was replacement cost used? Is a building similar to that. In its current conditions, what would be its value? Current value is market value minus transaction costs. So there are all these theories of valuation. And for a long time, there were really theories. The moment the U.S. inflation went down from 18% to 5%, FASB 33 was made optional, and no one else ever used it. It's still in the books. It hasn't been obsoleted. It's sitting there. And maybe if we get a big surge of inflation when quantitative easing gets closed, which will be pretty soon, they will resurrect it. Obsolete rule, stupid idea. But very valuable for valuation of physical assets, prices that are being transacted today for the physical assets you have. Inventory, property, plant, and equipment. If you hold shares on a non-marketed company, equivalent companies, what's their value? Is that more important than, is better information than historical cost? Much better information. And actually this idea of fair value, which is now big in the standards, is actually going in that direction. And there are many things that you can fair value now. But they haven't got to the point to say, hey, use electronic markets, do the decent thing, do the good thing, because they don't know. That's my opinion. You know, I met with Bob Hertz, who was the chairman of the FASB until recently, and we were in a company, and we were just talking about it. And I asked him why they didn't adopt this thing. And you know what he told me? He said, no one understands it. And I said, I told you so. And he said, well, just because you said doesn't mean anything, correct? And just this is what you need to remember, interoperability. In order to provide better information of transmission, you need to create interoperability. And if you have common standards, things are much easier. That's why having IFRS in one direction, GAAP in the other, is not very good. Having 100 different standards for XML, we should have a little bit less, although we need more than one. Okay, and of course, most things in the next decade or 2 decades will be automated. So the standards are going to merge, because for using computers, you need standards. So what I said, current reporting model is not sufficient anymore, is not timely, doesn't have enough information, and ignores performance. And now I'm going to show you something. This is, remember I mentioned last time the EBR, Enhanced Business Reporting Committee of the AICPA. I'm actually going to show slides that were generated not by me, but by the EBR guys, by the AICPA, talking about financial statement. You know, remember what I said. When there was a big meltdown of 2003, which wasn't the financial institutions, was WorldCom and Enron and the dot-coms. When that happened, everyone said the financial model is broken, let's do something. Started EBR. As soon as things kind of got a little bit better, no one wants to change anything. And so they basically forgot the work and etc. So what did they say here? The problem with business reporting is oriented toward the past, not towards the future. And instead of periodic reporting, you need on-demand reporting. Report when you need it. Second, instead of historical, you need real-time reporting with the future. This is not my slide. Instead of cost basis, you need value reporting, fair value. Instead of financial comprehensive. Now that's one thing I didn't talk enough, I mentioned in the past, is a financial number is something you capture today when the transaction is initiated. It doesn't deal with the fact that you have to do marketing, you have to buy inventory, you have to do all kinds of things for the thing to happen. I mentioned Bill McCarthy here last time. He said, by the time we make our first bookkeeping entry on a financial transaction, most interesting things about the business. You know, stockholders don't care about the past. They want to know how this company is going to do in the future. Correct? Who cares the past? Past paid already the dividend or didn't pay the dividend. I want to know what's going to happen tomorrow. And you say, well, why didn't we do this always? Because technology wasn't here. Analytic technology and database technology got much, much better. Other things they talk about, instead of financial statements, custom reports, instead of looking backward, looking forward. Yes? A little bit louder. When you're in the back, I don't hear you very well. Yes. Both. Both. But EBR was really oriented more for the external business reporting. Okay? Internal business reporting, hey, the ERPs are doing some of this. ERPs are full of perspective reports, helping dimension levels of inventory, helping you to project sales, helping you to measure cash flows, helping you with your finance needs. They exist. You answer your own question. You answer your own question. What would you answer to that question? I think there would be information of value doing that. And some companies actually do publish forecasts. Okay, but in the US there is tremendous worrisome about that because of the litigation environment. There were actually FASB standards for forecasts, guidance, not really very serious. Would you like to see them?
No, I was just curious.
No, I want to ask you, would you like to see them? I would like to see them. Of course I would like to see them. Of course I would like to see them. And you know, not only I would like to see them, I would like to see also a statement. Meaning you can create any statement, the cost of divulging it is zero. You put it on the web, anyone can look at it. I would like to see also a comparison of forecasts and actuals for the last 10 years. This management told me that we are going to earn $3 per share. We only earned $2 for the last 5 years. You know what that would do? What would that do? Would make people do their forecasts reasonably realistically. Because people would accumulate. And by the way, if they publish forecasts, even if that's not on the report, analysts will keep them and put them in a database and sell them to the public in XML format so you can put it in your spreadsheets and you can analyze it. It's a buck. It's a way to make a buck. And by the way, if you guys come up with hot electronic accounting analysis, you'll make money. You'll sell it. Sell it to Bloomberg. Sell it to anyone that sells information. Now, okay, you asked this question. Would you all like to have forecasts in financial statements? Detailed forecasts? And why aren't they being published? I think most users and accountants would be open to. Accountants would love this. Why? More things to audit, more things to perform, more money in our pocket. Also more noble reporting. Okay, things are more interesting, more intellectual, as opposed to green eye shades and bookkeeping manually. The firms would love it, would create a forecasting department and sell services, would violate Sarbanes-Oxley, but that's a different story. Yes?
But since there are so many forecasting models, don't people prefer the historical financial statements because then they can apply whichever model they think is best?
If you think that way, give the data for the forecasting, let people use any model they want. Give them a library of forecasting models. I think it's much better to ask management to do their forecast and justify. It's okay if you have a regression prediction, linear prediction, and then you make it higher because of this, and that reason. Management knows things that you don't know. And then if for 2 years they are over-optimistic, either kick the bum out or discount what he says. That's why you get the big bucks to make these predictions. That's why an accountant makes more money than the guy carrying the bucket outside. Okay? What I'm told, and I was talking with Anthony and William yesterday, and I asked him this too. It seems to be true. You go into Big Four, if you stay there for 6 years, your salary doubles. And you stay for 6 more years, it doubles again. Not bad. And that's why one of them told me that's why I don't go to industry. Because I would make more, 20% or 30%, but would stay at that. So that's why you made the big bucks. To put your nose in the line and make predictions. But I think the reason why this doesn't happen is conservancy. People are very conservative. And the reason is that the rules still, there is a lot of rules about issuing forecasts and etc. Makes things difficult. And I told you there are a lot of anachronistic rules out there that needs to get out of books. You know, when we are going to be talking with the public company PCAOB, and we are going to, the topic of the conversation, what analytics you can apply in auditing. Because the PCAOB is doing the following. It's going to the Big Four and reviewing audits that they find problematics and giving them help for what they are doing. And one of the things they are doing is they are basically requiring more manual sampling. So they find a large company, they pull 60 or 70 samples, meaning 60 transactions out of 1 million, and that's very valuable. And if you only pulled 40, you're not good. But if you do a statistically based analysis, they ignore it. So it's a big delay on advancing audit analytics. So we managed to have a voice with the PCAOB. We're going to have a conversation with them. And what we are going, and you know, even the firms, one that we work very closely, is saying, we'll do the sampling for humor them, but that's not what we really need to do for auditing. And what we need to do is change the rules. And it's not only changing the rules, it's deleting a lot of rules. Deleting rules that hold back. The sampling rule is idiotic. In a modern age of millions of transactions, pulling physical samples makes absolutely no sense. And you know, you find evil Big Fours there. So what I have here is actually the idea of the EBI. look at 5 different things. Disclosures you can understand. Corporations that are accountable, I mean they publish a report and stand behind of it. Ways to disseminate information. This is 2003. And financial and non-financial measures. Al Anderson from the ICPA published this when they called the EBR together. What has happened in 10 years? Information dissemination, XBRL. Now you're not sending 10,000 financial statements by the mail. You created a way to pass information everywhere. Problem is the content of that thing, not its dissemination anymore. Understandable disclosures, no progress. And by the way, I'm not totally sure that this idea of understandable disclosures makes sense. You know, have you ever realized that the financial reporting model of the United States is one report for everyone? And this report should be understandable by the naive investor. Now, what is the reality today? Reality is that 90%, 95% of the users never look at a financial statement, maybe even more. The predominant mode of investment analysis is the surrogate method, which is you ask an analyst or you ask a broker to recommend, and the brokers ask people like my son to recommend, who is an analyst. That's the model. So why are we publishing a financial statement that's understandable to everyone if everyone doesn't look at it? Because understandable to everyone is not understandable to everyone. They are very intricate. They have been amended 20 times. It is not that way. The other thing is, why can't we have a statement for the naive investor and a statement for the sophisticated investor with much more detail? Should we? And before you can do that, you would have to send these things on the mail, thousands of pages. Couldn't do it. But now, whatever you put on the website is there for everyone. Want to charge people for more detailed information? Why not? People think are going to make a buck out of your information. Charge them something. Decrease the cost to your stockholders. So that's kind of an interesting thing. Corporate accountability actually got a little bit better. With Sarbanes-Oxley, they forced people that prepare reports to write statements of, say, I know controls are good and these numbers are right. So there is some personal, but that was an improvement. Reliable systems was that kind of brilliant idea when they started. They started the committees looking at computer reliability. And we publish SysTrust, we publish WebTrust, and there has been much more emphasis on looking at system reliability. And this non-financial measures haven't got anywhere. And you have to understand, you know, you guys got got a taste of this when we tried to measure. Remember, we tried to measure human resources, intellectual property. And what you all said is, these are crap measures. And they are. But as an investor, if you say, I'll give you financial measures, the way they are published today, and I'll give you this crap human resource information, I'm not sure if you all would want it, but I guarantee you my son would eat that thing alive. Would immediately go and look at the literature, compare companies, pay some human resource consultant to come in and look at the thing, and dig deep as he could. And people do that for pharmaceuticals. They are required to disclose much more on the IP. They do that very deeply to companies that do oil exploitation and extraction, because they are required to publish much more about reserves. So, you know, more information is useful, And always have to be careful if this is not fake information. I want to show you this thing, and maybe I'll let you go after. My apologies about my cough, but I don't like to cut classes. So I come, if I am still alive, I show up, okay? And even with a very helping she could teach for me, my class, I'd like to teach it myself. So this is actually the chart we used to sell XBRL. And what we try to do here is explain the financial value chain. Remember the question in the supply chain. Business operates. You create an internal financial report. Out of the internal financial reporting, you create a subset which is the external financial report. These are part of your ERP. This has to be passed over to the many users, the government, the investors, the credit agencies, et cetera, et cetera. And the societal cost of re-preparing the information is very, very large. And so if you create it electronic, you make the life much easier. And these are all the peoples that actually need it. The companies themselves, publishers of data and data aggregators, investors and creditors, regulators, and these are providers, software vendors. I'm just going to finish this with a little story to motivate you. I tell a lot of stories. Holland. Holland is an interesting country. Tiny country, but for a while they were the world leaders in commerce in the 1600s. Accountants there, traditionally, were not accountants, they're economists. You had to study economics and then become an accountant. So they have an open view and they try different things. So they did a study of the things that the Dutch government asked. I'm not talking about the Dutch football team that win 4-0. But the Dutch studied what they are asking companies to do. And they came up with something like they were asking 20,000 items of information. And they pulled together the census that they were asking information, tax information, and corporate reporting information. And they did a study why they were asking that information. And there were things there they couldn't even explain why that information was being asked. So they decided to simplify this. They created a thing that they call these three. The Census Bureau, the Tax Bureau, and their SEC came together and reduced those 20,000 items to something like 600 items. And then they went with the software vendors and got the 7 largest software vendors and say you have to create extraction procedure for your ERPs that create these reports with 600 pieces of data. Twisted a lot of arms. And they got this thing done. And they dramatically simplified the Dutch reporting system. Since then, the British are trying to copy it, the Australians are trying to copy it. Ask me if the US is trying to copy it. They are creating more and more complicated reporting. Okay. But there is hope in the air because the Data Act is a first step to force the government reporting a little bit more, keeping some information that is needed, and maybe there'll be a standardized business reporting effort in the future. There are a couple of senators that are very interested on this thing. So that's for today.